So again, I think a pullback to the 20-day moving average, which is kind of this first level of support for the market, that puts you right around 6,000 on the index. I think that's fairly decently possible next week. And then after that, we're going to start to rally for end of the year. And again, that's where, if you kind of run this trend line out, that's where 61, 6,200 kind of comes in for that kind of year-end rally.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week with my good friend, portfolio manager, the Yuletudinous Lance Roberts. Lance, how are you?
I'm doing fantastic. And just to let you know, this is your friendly bro alert, right? Which is today's the 13th. By the way, it's Friday the 13th that we're actually having this conversation.
Yeah.
But that's 12 days to Christmas. And Amazon is running like 3 days behind on deliveries. So if you haven't done your shopping yet online and you expect to get it by Christmas, you're pushing the edge of the envelope. I'm just talking to you husbands out there right now, not to forget that Christmas is right around the corner. And unless you want to be in the doghouse all of till New Year's to get busy.
Yeah, you're making me nervous because I'm definitely one of the guys who's behind the eight ball right now. And this is actually releasing a day later. The earliest anyone's seeing this is Saturday the 14th. So you can get a day less, right? All right, but well, anyways, important public service announcement for us men out here.
That's our husband PSA for the week.
Okay. All right. Well, look, let's get right to the markets, Lance. Just saw some headlines this morning, starting to sum up the year. Unless something terrible happens in these next couple of days before the end of the year, this will be the best year of the century in terms of stock market performance. Stocks are back near all-time highs, but they've been choppy. But I believe this is what you have been telling us to expect, correct?
Yeah, over the last really kind of 2 weeks, and both our daily market commentary as well as our weekly newsletter as well, which you can get all that on Substack. Is that we are heading into the kind of a very seasonally choppy point of the year, because this week and next week, so through the 18th of December, you have the annual distributions for mutual funds. So if I run a mutual fund, any type of fund structure like that, I have to distribute all of my capital gains for the year, my interest, and my dividend income for the year. So that's got to be sent out. Well, in order to send that out, I've got to sell positions in the portfolio. The other thing that's occurring this week, and you've noticed a lot of this, there's been a lot of chop, but if you kind of look at what's been moving around in the market, you've seen big moves in like Google and Apple hit new all-time highs. That's portfolio rebalancing. A lot of these, we talked about this earlier in October, is that a lot of hedge funds and managers were de-risking portfolios going into the election because they really didn't know what the outcome was. So we saw a lot of pressure on kind of these large mega cap companies. This is where we're getting a lot of rhetoric from kind of the mainstream media talking about, oh, AI is dead. It's the mega cap trade's over, blah, blah, blah. And that really wasn't what was going on. It was just de-risking those kind of big weighted positions in portfolios and allocating to some underweighted positions in portfolios. So we saw that kind of rotation in the market through the election. Now, coming out of that election, managers are deeply underweight these big mega cap stocks. And that's why you've seen a 54% surge in Tesla as a good example. Just since the election. Of course, it's not hurting him at all that he's kind of aligned himself with the administration.
Right.
But managers are trying to weight up those positions in portfolios. So this week you've seen a lot of selling in high flyers like Palantir and GE Vernova, things like that. And you've seen companies that were underweight portfolios getting bought up. So you saw the Apples and the Googles doing very well. That persists through next Friday. So I wouldn't expect this to be over. I think you could very well maybe expect some more chop next week. Nothing major, but you could see some more chop into next week. One other interesting dynamic that's going on is bonds have been under a lot of pressure. We had a big rally in bonds coming out of Thanksgiving. Bonds have been under a lot of pressure this week because they're getting sold off, and they're getting sold off for tax loss harvesting. So we're seeing a lot of that tax loss harvesting in bond portfolios this week because I can turn right around. If I sell those at a loss, I can turn right around and buy those back in January as soon as we get past 31 days. So you're seeing a lot of that kind of that. Of course, bonds were really overbought going into this week as well. So you're getting a kind of a technical rebalancing as well as some tax loss harvesting because and a good example of this is our portfolios that we manage. We have no losses to harvest in the equity side of our portfolio. So the only thing that we have to harvest, and we did this earlier this year, we actually harvested losses back in, I think, March or April of this year, but was in bonds. So we sold our TLT for our clients, and we bought individual treasuries, and so we captured that tax loss harvest without changing the allocation to bonds. So now we're going to have that to offset on the gains that we took this year. We took quite a few gains along the way this year, so we'll have that to rebalance. But that's what's happening in the market this week and next week. That once we get past that Friday of next week, that's your Santa Claus rally into the year. That's where all the mutual funds, portfolio managers, et cetera, are now just putting everything to weight in their portfolio that they want to have, because when their annual report goes out, they've got to show they own Palantir, GE Vernova, whatever it is that they need to have on their balance sheet. That'll all get bought into the end of the year.
Okay. So the one thing I didn't hear you mention that you mentioned last week, in addition to all those other things, is that it's been a great year, right? It's been the best year of the century. And that people running a traditional 60-40 portfolio are probably now more like 65-35, and they've got to sell down the equity stake at a minimum to get that back into realignment. So you're having that sell pressure as well, right?
Right. Yeah, and that was part of what I was saying is rebalancing portfolios, and that's why you saw Apple and stuff that was running up. They were rebalancing in those structures. So yeah, there's been, so that reduction in equity risk is another reason you're seeing these. Like this morning, Friday morning, we opened up fairly strong and then immediately sold off on Friday and went negative early Friday. So, when you and I are talking right now, it's only about 10 o'clock Central Time.
Markets are red, yeah.
Yeah, and markets are red. So again, that's all that's going on. And by the way, another PSA real quick here for the thoughtful money crowd. I get a ton of emails every year about this time from people that own mutual funds. So if you own an investment that has 5 letters and it ends in X, right? That's a mutual fund. They have to distribute, as I said, all their capital gains, interest, and income this year. So you're going to wake up one morning and your mutual fund's going to be down $1, and the market's going to be up and your mutual fund's down $1. That's the distribution. You didn't lose any money. There's nothing wrong with the fund. You don't need to panic about it. Wait 3 days. And if you don't dividend reinvest, your cash will show up in your account, or you will get more shares of the fund, one of the two. But if you wake up with a big funky thing in your mutual fund, that's all that's happened. It's just been a distribution, so don't panic.
Just wait a couple of days, it should all even out.
Yep. Exactly.
Okay, so I'm glad you mentioned bonds, because I was going to go there, because bonds, having another bad week. As people have been tracking this trade through this series we do. People have been sweating a bit. And of course, you've said many, many times, don't, right? Now, I get the tax loss selling, right? What are the things you sell for tax loss selling? The things that have had a bad year, right? So it totally makes sense, right? Now, I imagine part, though, of what's going on in bonds as well is we just got the latest inflation data. It's looking stickier than I think the Fed would want. The market still very clearly thinks the Fed's going to deliver a 25 basis point rate cut next week. But its expectations of future rate cuts maybe are getting moderated a little bit here, right? And obviously the bond market, if the bond market thinks that inflation is going to be around longer than it did, will likely ask to get paid for that by higher yields on the long end of the curve. So that is playing a factor as well, correct?
Absolutely. And again, this is, if you take a look at the trend of inflation, it is lower. But, the expectation, and again, you and I talked about this, I think 3 or 4 weeks ago. Look, if you own bonds right now and you're expecting an immediate decline in inflation to sub 2% and bonds are going to go to the moon, you don't need to own bonds. If you're, wrestling, with your bond position every week psychologically, sell them, get rid of them, get them. I had a gentleman email me this morning, and he's like, "Oh my gosh, did you see the inflation number? What does this mean for bonds?" I'm like, "It doesn't mean anything. It's just, this year-over-year comparison nonsense that we do doesn't really mean anything. It's the trend that's what's important." And we can go through some graphs. If you take a look at economic growth in the Eurozone, Japan, China, there is no economic growth. In fact, the UK is on the verge of recession right now. We're the only country experiencing GDP growth. Well, you go back and track that through history, these divergences can happen temporarily, but the weight of economic weakness globally is going to drag the US lower. It's just a function of time. But the point is, as an investor, here's a simple rule of thumb. If you spend more than 24 hours worrying about a position, like you're staying up at night worrying about it, sell it. It's not important, right? Don't worry about it. If you sell it at a loss, great, no problem. Write it off your taxes or write it off your gains somewhere else. Don't invest in stuff, A, that you don't understand, B, that you don't have the stomach to to kind of handle the volatility for, or C, if you really don't have the right outlook for the duration of an investment. So again, remember, I own bonds because we run balanced portfolios. We run 60-40, 80-20, 70-30. I don't buy bonds to trade them. I buy bonds because they're part of our long-term allocation for risk management. But if you're buying them for a trade, that trade's not working right now. So again, sell it, move on, come back to the trade later. You have to remember, as an investor, you have to not only manage the risk of the asset class that you own, but you have to manage the risk of your own emotions. And so if you're staying up nights worrying about some investment in your portfolio that's not working for whatever reason, sell it. Move on to something else. There's other places to make money right now. We can always come back to a trade later. Just because you sell bonds at a loss today doesn't mean you're forbidden. It's like forbidden. You can never buy bonds again. No, that's not what that means. You can come back to the trade later when it starts working and make that trade again. So, again, just, you have to balance that emotional risk with everything else. And so, again, don't worry about what I'm doing, right? I manage positions for a very specific reason. And if something's not working the way we expect it to work, we'll sell it, right? I can tell you my horror stories of CVS. I've bought and sold that thing at losses 3 times now. I'm never touching it again, which means it's probably going to go up. But
I'm buying CVS. Right, there we go.
That may be your clue, right? But no, it's just. But even with those positions that once we recognized it wasn't working the way it was working, we sold it. It's not worth the emotional drag.
Okay, so I appreciate that. Another PSA you're giving our investors today. Let me just ask some clarifying things, though. You at RAA, you and your partner Michael Leibowitz. And I hate to keep asking you this, but I think just people want to know. You are not changing your position, your strategy on bonds, given the recent developments.
The fundamental data that drives interest rates in the long term has not changed. In fact, it's very favorable. The longer term trend in interest rates will be lower unless the government comes out, so Donald Trump takes office in January. Now, if next year he comes to market and says, we're going to do a $5 trillion infrastructure spending program, and we're going to focus everything on domestic spending. We're going to build out power grids. We're going to build utility companies. We're going to invest in nuclear facilities. We're going to do all of these things. I'm immediately selling bonds because that will be very inflationary, because you're going to create a tremendous amount of economic growth. You're going to shift the dynamic of the economy into an economic growth phase. And in that phase, I want to own equities. I don't want to own bonds. And so we'll have to we will shift that entire portfolio structure to very short duration bonds. Again, I have to own bonds because I run balanced allocation models. We'll shift to very short duration, essentially close to money market for that portion of the portfolio, overweight equities to a large degree, and then ride that train from where we go from there. But that, the trend of economic growth, employment, all those things that you talk about here on the show all the time with your other interviews that you do, those are all weaker. And those are what drive long-term interest rates, not short-term variations on food, the cost of eggs was up this week. Well, yeah, eggs are up. We've got a shortage of supply and you have Thanksgiving. So yeah, eggs are going to be higher going into Thanksgiving, people. It's just, you're going to get these variations in the data, but the long-term trend of inflation is lower. The long-term trend of economic growth is lower. The long-term trend of wages, which isn't keeping up with inflation right now, is lower. And all of those are your basic dynamics that drive long-term interest rates.
Okay. You just mentioned the difference between what's happening with wages. Remind me to show you a chart in just a minute around that. All right, I just want to flag. So I just recorded an interview with Jan Van Eck, CEO of Van Eck Funds. He walked us through this kind of a nice new thing we've been doing on the channel the past couple of quarters. He comes on at the beginning of the quarter. Or end of the quarter, if you will, and gives us his outlook for the coming quarter. It's a total privilege to have him be willing to do that on this channel. He looking forward, and I would say this is a multi-year view. He thinks that inflation will be secularly higher going forward. Not in a straight line. If you're interested in that case, folks, watch the video with Jan when it comes out tomorrow. I don't necessarily think he would differ with you, Lance, if we're, depending on the time scale that we're talking about. In other words, maybe they could go lower and then get higher again. A question I asked him was, at what inflation rate would the market really start to get worried about it? Like what CPI headline would markets say, oh, wait a minute, like inflation's really becoming a problem again? What would your answer to that be? And maybe like at what CPI rate would you say, you know what, maybe this bond position we're in is the wrong thing to be, duration's the wrong thing to be in if inflation got up to X?
Yeah, well, inflation can't get up to X. Again, you don't have, with X, see, this is the one thing that everybody keeps forgetting. And let's just go back to the basics, right? So everybody projecting secularly higher interest or inflation rates and interest rates going forward, they are assuming that the current bout of inflation and economic growth we have is organic. Everybody forgets how we got here. Mm-hmm. Which was shutting down the economy and injecting almost $8 trillion in total into the economy. That's all working its way out. And so this is why I said, the caveat to all of this is whether or not we start doing more infrastructure type spending bills, another Inflation Reduction Act, another CHIPS Act, those type of things. Right now,
sort of, so goes the deficit, so goes the story.
No, that is incorrect. So goes the deficit. That is, if it's just deficit spending to support current mandatory spending like social welfare, affordable health care costs, those type of things, those are non-productive investments. Those are deflationary. So the deficit as a function is disinflationary. It is not inflationary. What is inflationary is when you inject capital directly into economic activity, AKA the CHIPS Act, AKA the Inflation Reduction Act, or sending checks to households, and you shut down the economy at the same time. So you have a supply-demand imbalance. I've got a big demand for stuff, but no supply to meet it. That creates price inflation.
But don't those drive the deficit too?
No, yeah. If I do $5 trillion worth of inflationary, of productive investment, that's going to create a short-term increase in the deficit, but that's okay. See, that type of spending is okay. We should be all on board for deficit spending that's productive because that pays for itself over time. If I build nuclear power plants with $5 trillion, I'm just throwing out numbers, but let's say I have $5 trillion nuclear power plants that now people are going to receive energy from and pay electric bills on for the next 150 years. That's a great investment. We should do all of that we can. Hoover Dams, Tennessee River Valley Authority, those are the things that we should be doing with government spending. In fact, that is in line with what the Constitution says the government's responsibility is in terms of creating national security. But
I'm following you. That increases the deficit in the short term. It's inflationary in the short term, but you get a much better long-term return out of it.
Absolutely. And the deficit will be paid off by that investment, right? So that's okay.
In theory.
In theory, yeah. Assuming that we only use deficit spending for productive investment, we wouldn't have a long-term budget deficit. It would be paid off over time because we'd repay the debt. The problem we have, and the reason that if you go back to 1980 when we started actually deficit spending to a large degree, it's all been for non-productive use. And ever since 1980, we've had a steady decline in economic growth. We've had a steady decline in inflation. We've had a steady fall in interest rates because that type of spending is non-productive. And non-productive spending has a negative multiplier in the economy. It slows economic growth, creates economic disparity among the classes. And
That's the Lacey Hunt warning bell. Yeah, I got it. Yeah.
and so that's just the data. That's what the data tells you.
Okay. All right. Okay. So anyways, putting a bow on this, you're not sweating that much about bond yields, and we've sort of talked about what's been driving them in the short term. All right. To the chart that I mentioned. Yeah, we've had some chop this week, but we're still, above 6,000. The euphoria meter that we showed last week, record highs. You've been writing pieces about investor euphoria and speculation, that these are generally signs of a speculative peak, or that you see near a speculative peak. So just one more chart along that theme here. I don't know if you've seen this chart, Lance, but it's basically showing that there's been a pretty tight correlation between people's expectations for their income and for stock prices. And right now, there's just a massive divergence where people, aren't particularly sanguine about increases in their income. But man, who worries about that? Because we're just going to make a ton of money in the stock market, right? Yeah.
I tweeted this out. I said, my tweet was basically that chart, and it said, consumers, man, my life sucks right now. Also consumers, but the stock market's on fire.
Yeah.
So it's a real dichotomy between, the stock market and speculation and, how people kind of view their world in general. But this also kind of goes back to one of the issues. So like tonight, I'm going to have a debate on zero hedge with Michael Pinto talking about markets. And, one of the big dynamics that have changed in the world is since 2020. And again, the big mistake that everybody makes right now, whether it's, people with bearish stock market outlooks or people with bearish economic outlooks, whatever it is they're assuming that, or bullish economic outlooks, I'm sorry, I should say that, is everybody's assuming that what we've seen over the last couple of years is normality. And, here's the excuse me. I wrote an article recently talking about Paul Tudor Jones and his outlook. And one of the problems with his outlook is assuming that, we're different than Japan. But this is a long-term look at wages, GDP, and inflation. Pardon me. Going back to 1965. And if you make a composite index of wages, GDP, and inflation, it has a very, very high correlation with where rates go, which is exactly what you would expect. Rates are where they are right now because that's where they should be, because that's where economic growth, wages, and inflation are. But economic growth, wages, and inflation are declining. And as those continue to decline, so too will rates. And the reason that economic growth will decline is that you're not creating economic prosperity across a bulk of classes. Creating stock market wealth is fine. And you and I have had this conversation, but that's only 10 to 20% of the population that participate in that wealth effect. The bottom 80% don't. They're just living paycheck to paycheck. And all that excess savings they had are running out. And that's why we're seeing record credit card debt, all those type of things. And this is a big risk going into next year for the Trump administration, as that if you try to start cutting a lot of government spending, which is what's been driving the economic growth over the last couple of years, now you really kind of pull the cover off the car, so to speak, and you're actually going to see what's underneath that cover. Because again, we've seen very, very good economic growth because of all the government spending. And if you're going to take that away through, the DOGE or whatever, the real economic growth rate is going to show up, and that's not nearly as robust as people think it is right now.
Okay, and so this gets back to our conversation of the past couple of weeks of should the Trump administration be getting out in front of this and saying that, hey, folks, we're going to have some rough sledding for a while, but we need to be able to get to where we want to go.
He actually did that. I don't know if you happened to notice that he was on, he rang the New York Stock Exchange bell the other day. Did you see that?
I did, and my wife had to remind me that we did it a few months before him, so we
You
felt
are,
pretty smug.
you are up there with the elite, but it was great because Jim Cramer interviewed him. And Jim Cramer had his mic there at the podium of the New York Stock Exchange. And I'm paraphrasing, so if you go watch the clip, it's actually much better. But he actually, I don't know if he's been listening to the show, Adam, but he actually kind of did what we said he should do. Jim Cramer said, "Should Americans be buying stocks?" And he's like, he's like, "Well, Jim, you know better than anybody that the market can dip. I mean, because you're the kid, you call the rallies, and you're always buying the dips." He really kind of put him on the spot there. He says, "Look,"
Yeah.
but he did say, he says, "This market can certainly dip, and but I do think long term, if I do what I say I'm going to do, that the markets will benefit from it." And he's right about that. But he at least laid out the case that when he was asked, should Americans be buying stocks right now? He says, hey, the markets can dip. And I think he's aware of the fact that some of these policies he's going to do may kind of startle the markets, at least near term, especially given the exuberance that we have in the markets right
Yeah, and that's where I want to go with this. And you're right. He was interviewed earlier this week on NBC, and it wasn't so much about the market, but it was about inflation. Actually, it was about prices, and they were kind of trying to get him and say, hey, so are you saying that prices are definitely not going to go up from here? And he said, are you going to guarantee that prices don't go up from here? He said, hey, I'm not going to guarantee anything.
now.
Like anything could happen, which I actually think was the absolute right answer to give that. But it was a change from the old sort of chest thumper, you're going to have the most beautiful economy from day one with me, type of thing that he did in his first administration. And I actually saw an article yesterday written saying, hey, one of the things that's been absent from a lot of what Trump has said recently has been the stock market. He just hasn't talked about it that much, unlike what he did during his previous administration. So who knows? Maybe people have been sending him, some of the notes from these weekly market recaps, Lance. We'll see. I think we don't have enough data yet to really conclude one way or the other. But I go back to that chart that I just showed you. To me, I look at that, and that kind of captures what I think is the mentality of the average investor right now, which is, hey, my life kind of sucks if I'm just looking at my paycheck. But it doesn't matter because I'm going to get rich off MicroStrategy.
That's right.
Yeah, and I tweeted that actually and got a lot of pushback from the Bitcoin MicroStrategy folks. And I wasn't trying to beat on just MicroStrategy. I was just picking on it because it is the stock that is leaps and bounds, outperforming everything else for reasons I want to ask you about in just a second, Lance. But to me, that is this cycle's version of everybody piling into Dogecoin like last time, right? Which is like, hey, I'm not going to be able to afford a house, or I'm not going to be able to, afford these other things that I want unless I get this apparent winning lottery ticket, which everybody's jumping on. So I'm going to jump on that too. And of course, when that mania, if it indeed proves to be a mania, evaporates, hits its zenith and then corrects hard, it's those people that get sucked in, at the late stages that are the ones that can afford the losses the least and get the most permanently impacted by all that.
Yeah, and look, this is the very interesting. This is the kind of the fascinating thing that's been going on. Hold on a second, I'm pulling up a chart for you real quick as well.
Okay, yeah.
The One of the most fascinating things that's happening right now. Again, we go back to talking about how people think what's going on right now is now back to normal, right? We've all forgotten about the pandemic, and so what's happening right now in the markets is entirely normal, and it's not at all. But what's interesting is that there has been a shift in psychology that is actually quite fascinating. And it started back in 2021 when we started sending checks to households and we had the whole economy shut down. Nobody, you remember, you couldn't go to the casinos to gamble at all. That wasn't available. You couldn't go to, do sports betting. That was completely out. So what was left for gamblers, right? The only thing they could do was load up a Robinhood account and take that $1,500 check and start buying meme stocks.
GameStop, yeah.
GameStop, AMC, Bitcoin. Remember, everybody back then had laser eyes and their Twitter accounts, and Bitcoin's going to the moon, and it's all rocket ships everywhere. And we warned you back then about the speculation. And here's what's absolutely fascinating about all this. Let me show you this chart. So this is a chart from our past weekend's newsletter. Let me make this a little bit bigger for you. So this is just the market going back to 20. So that dip on the left, that little correction on the far left, that's a 35% decline in the markets, right? It hardly even shows up now, but that was a 35% fall off. Oh my God, the world has ended, total market crash, right? Bear market. No, it's just a correction. Then we cut rates to zero. We do $1 trillion, 1.2 trillion a month in QE. We start sending checks to household, and the market takes off. So it's Bitcoin, it's IPOs. And we couldn't get IPOs out the door fast enough. So Wall Street starts selling SPACs to everybody, the ARK disruptor companies, options, meme stocks. It was all that was going on. Now, here's the fascinating part about this. I get that part, right? Totally get that part. Lots of stuff going up. Now, what normally happens during a bear market is that nobody wants to own any stocks, right? So you have FOMO on the way up, right? That was why Wall Street was coming out with just, if they had a crappy asset on their books, they'd spun it out into a SPAC or an IPO because people would buy it. They're like, wait, finally, just like that one item in a store that nobody ever buys, and finally there's one sucker that comes in like, oh, thank God we sold it.
Right. And we've talked about it. To me, this reminds me growing up on the East Coast where the bluefish would run, and you would see this feeding frenzy, and you could literally throw anything in, just a hook, no bait, anything. They would bite it, right? So that's what it's like for Wall Street during those times. Yeah,
exactly. So they printed money. It was awesome. But here's the fascinating that happened in 2022. So in 2022, Bitcoin fell 50, 60, 70%. A lot of these meme stocks fell 70, 80, 90%. Companies like Roku and others, fell 90%, lost 90%. Peloton lost, 90% of their value. And you would be thinking at that point, people would be going like, I'm done investing. I don't want anything to do with the markets anymore. That would be the logical response. That's what you would expect in that type of a correction. But no, that's not what happened. All the way down, I was getting flooded with emails every time we sold off, and the Fed came out and says, nope, we're not going to cut rates, and the market would sell off. And immediately I get emails like, is this the bottom? Is this the time? Do I need to get in now? I don't want to miss the bottom. Tell me when to buy the bottom. And we had this FOMO, this fear of missing out on buying the bottom all the way down. It was absolutely phenomenal. And when the market started finally bottoming and began to take off, we're back to Bitcoin and zero-day options and leveraged ETFs. We have more money going into leveraged ETFs right now than ever in history. Just a massive surge in leveraged ETFs, single stock ETFs. AI companies, people just can't, buy enough of them. And there's this fear of missing out again, back on the upside, and laser eyes are all back on Bitcoin and everything else, right? MicroStrategy is going to go to $1 billion. And that's all fine and dandy. That's the speculative process. But but my point here is that there was a mental shift that occurred to where nobody is worrying about a 50% correction anymore. Why? Because they know now that the Fed is going to step in and bail it out.
Wait, no, the Fed and Congress.
The Fed and Congress, that's correct. And so over the last decades, right? So 2008, at the bottom of 2008, nobody wanted to buy the market. You couldn't sell stocks to anybody, right? That was not going to happen. Nobody was buying stocks. 15 years later, you can't scare people out of markets because we've now taught them that the Fed and Congress is going to step in and bail out the market. So whatever it is. So when people like Michael Pinto go, oh, there's a 50% correction coming, it's going to wipe out investors. No, because the Fed's going to step in and bail you out.
So I would like to see you and Michael talk about this tonight.
It's a big point of my debate with him, which is, here's another fascinating fact. If you just take a look in 2021, right there, coming out of that bottom from March of 2020, you had about $850 million go into, $850 billion. I had to get my numbers right. $850 billion flow into ETFs during 2021. That was a record. That was a record inflow into ETFs. Of course, we sent people money. Now, just in the last year, we've had over $1 trillion now go into ETFs, and a lot of those are leveraged ETFs. don't have $1,500 checks. We don't have debt moratoriums. We don't have all that other stuff. What's fascinating to me is where all this money is coming from. It's a literal flood of money coming in. Foreign investors, hedge funds, but individuals themselves, retail investors are just throwing. They must be selling the kitchen sink, I guess, to put money into the markets right now. It's quite phenomenal.
So, well, I totally agree, and this is why I'd like to hear you and Michael talk about this. So, I don't know all the reasons for that, but I know some, right? And some of it is FOMO that people are now beginning to shake out the couch cushions, right? You're getting all the people who were resisted and are now capitulating and getting in. A huge part of it, I think, is what you mentioned earlier, is the US is the best and kind of only good game in town right now. And so the rest of the world is showing up to the party, right? So you're getting capital from the rest of the world flowing here. This is the whole Brent Johnson thing, right? And anyways, and you have this investor change in psychology that you mentioned, where it's like, look, it's a game that's rigged in my favor here. If the losses get big enough, the central planners are going to come in and have my back, right? So you've got all that stuff going on, which people that say, yeah, that's the game and you should play it, they're going to be right as long as this thing works, right? I think a lot of the people watching this, though, say, the reason why we had that sentiment shift is like the people capitulate when the pain gets big enough.
That's right.
Right. And I think, most viewers here are aware that we didn't go through a capitulation phase in 2022. And they're worried that, like, okay, so we're not going to see capitulation until things get a lot more painful than they were in 2022. And they think, look at a lot of these things, a lot of them aren't permanent. They could last a long time, but eventually the capital flows into the US will reverse, right? You'll get better deals in the rest of the world and capital will start going there. The US may start slowing, as you've been saying it will, and it'll start looking less good. Again, trees don't grow to the sky. So at some Cape valuation, even to the most manic bull, stocks look too overpriced. What is that? I don't know, 40, 50, I don't know, right? But so, they're worried that Michael Pinto is correct, which is, hey, at some point, this is all going to have to matter. And we, in historical cycles, will repeat. We will get to a capitulation phase, but it's probably not going to be a 20% decline like we saw in 22. It might have to be 50 or whatever, right? And of course, nobody knows when, but the math is, how long do I play with that sort of Damocles over my head? And of course, that's the world you live in. And I know you feel you share this concern. I know you don't dismiss it.
Right. No, that's the huge point, right? So we talk about predictions all the time, right? A prediction has to have three things. It has to be, what is the prediction? Okay, prediction is 50% correction. How do I deal with that, right? So you short stocks, but most importantly, of those three components of any prediction, when is and the problem is that Michael may very well be right, and that we have a 50% correction. And look, if I say, hey, we're gonna have a 50% correction, and we have one in 5 years, great, I was right, right? The problem is you missed out on a 200% run in the market or whatever between now and then. And that's always the hard part with predictions. And I absolutely agree with the fact that at some point you're going to have a correction of some sort. Again, you would have thought a 35% correction in a month back in 2020 would have certainly brought out the more bearish aspects of investors, right? I mean, if you lose 35% of your money in a month, you would probably go, well, maybe I don't want to invest right now, but they immediately jump back into markets, right?
Well, let me ask you this on that. So everybody assumes that's the playbook going forward, right? Is that we get in trouble. And I just wonder for a second, right? Like, I mean, the government did shut down the economy, right? So I think at that point, they could justify that extreme level of stuff. If they're not shutting down the economy, but the market is just suffering because of just sort of regular market forces, will they, I know a lot of people think they would, but will they take as extreme measures, or will they be like, no, we're not going to, like we did last time, because literally we're the ones that shut the economy down, but we're not doing that this time.
So that's a great point, right? That's a great differentiator, what you just said. So let's assume for a moment that, and starting January the 1st of next year, so I'm going to make a prediction. Next year, the markets are going to correct. I'll give you the amount in a second. It's going to correct. We're going to short stocks, and I'm not saying this, by the way. So this is an example.
Hypothetical. Yep.
Totally hypothetical. And the decline is going to start in the second quarter of next year. So there's your prediction. So now we can work with it, right? And in quarter three, you can say, well, I was either right or wrong. And that's why timing is so important about predictions. When is it going to happen? Because that way you know whether you're right or wrong, and then you can make adjustments. And so let's just say it's normal market forces, Adam, right? So what are normal market forces? So normal market forces are interest rates are too high, it impairs corporate profitability and earnings. Inflation remains too sticky, and so that impairs corporate profitability to some degree, but actually inflations are good for corporate profits, but it impairs the consumer. So earnings slow, right? And now the markets need to realign themselves for valuations. And so right now on a forward basis, we're trading, right around 21, 22, 23 times earnings. So if I need to correct that back to more normal levels next year, then I need to have some sort of pullback. Well, I'm doing an article. I'm actually doing this article, I think for next week, is I've taken current predictions of estimates, right? So estimates for the end of this next year is $251 a share. Now, assuming that, I can now make valuation assumptions. And I can say, okay, if valuations remain stagnant at 22 times earnings at $251 a share, the markets are going to rise about 6% next year. If we have a multiple expansion based on $251 a share in earnings, then we're going to get to about 7,200 on the S&P next year. So that's about a 14% increase. If I have a multiple contraction, this is what you and I are talking about. If I have a multiple contraction and valuations reverse to the historical norm going back to the turn of the century, that's about 17 times earnings. That's going to be about a 25 to 30% decline in the markets to realign those valuations. So that would probably not occur all at once. That would be a grind. It'd be something more along the line of maybe 18 to 24 months of just a gradual grind, grueling pullback in the markets, right? Just kind of like 2022 where you have decline.
Right, just extended, yeah.
It's just miserable. I mean, just a miserable 18, 24 months in the markets. That would be what you would expect, right? Just kind of this grinding thing, and it doesn't, and basically just wears people out. They're just like, I'm done with the markets. I don't want to invest because, but there's no reason for the Fed to step in.
Right.
Now, anything other than that, right?
And by other, you mean more acute, right?
Well, no, here's the problem. Historically speaking, going back through history, the market has never corrected itself on valuations. Never. I'll give you a second to think about it if you can come up with an example, right? But the market has never gone through a valuation correction on its own. It's always been some event that drives.
There's been a trigger. Yeah,
right. There's a trigger that shifts the valuation assumption because the trigger, the catalyst, makes markets immediately reassess the value of earnings. So no longer is it 251 next year, it's 200.
Right. And it's the sentiment changer. It's something that breaks or changes sentiment. Right.
So in general, and as we've talked about so many times, go back through history, it's generally a credit-related event of some sort. Something disrupts the credit market, and those assumptions have to become adjusted. And now there was a bit of a difference with the dot-com crash. Obviously, that wasn't really credit-related. That was the realization of all the phony balance sheets. Enron pulled that cover back on what was happening with accounting and going on with a lot of these companies. Of course, WorldCom fell right after that. Global Crossing, all the fraud, all the crap showed up in the dot-com companies. That was a little bit different, but that was still a credit, kind of in a way, credit related because there was a lot of debt tied to those balance sheets, right? So, but you go back, generally it's some type of credit related event. In that type of situation, the Fed steps in immediately.
Okay. Yeah. No, totally agree. And look, I'm not even saying that the Fed wouldn't step in, the Fed and Congress wouldn't overstep here, even if they didn't, quote unquote, break it like they did in 2020. But you can argue that maybe they might not, or might not to the extent they did back then. Right. Real quick, just to speak fairly to Michael,
I don't want anybody to think that Michael and I, are not friend. We respect each other very much. I respect his work a whole lot. Just because we're having a debate, it's really not a debate. We're having a discussion about markets.
Yeah. Well, I mean, I know the two of you really well, really, really well, both of you. And I think, you're aligned on 90 to 95% of everything. And that's what I was going to say here, which is, yes, Michael has said that the markets could correct by, or maybe even deserve a 50% correction. But Lance, you say the same thing, right? And in terms of the when, Michael says, look, I've got this 20-point, proprietary portfolio model that I have. And he says that will tell me when. So he doesn't give a time frame like, oh, it's got to happen by Q1. He's just saying, when my model tells me that we're switching from stage whatever to the next stage, then that's when I'm going to change my behavior. And I won't until, and he was just on this channel like a week ago, and he's still long, right? He doesn't love this market, but he's not fighting it, right?
I hate this. And my 21 point model says the same thing.
You have to have one just a little bit better. But I mean, you have said, Lance, the market could correct 50% tomorrow, and it still wouldn't break the bullish trend that it's been in, correct?
Let me give you a little sneak. Well, yeah, keep asking that question. I'll give you a little sneak peek at a chart I've actually prepared for tonight. So
okay. But essentially, all I'm saying is that you and Michael are actually saying the exact same thing.
Look, and again, this is not. If you're expecting a knockdown, drag out, yelling, screaming debate, and us calling each other names, don't watch the debate because it's going to be very disappointing. It's just, look, here I have great respect for Michael, as opposed to a lot of people that make video commentary that just come out and they just say extravagant things to, sell gold or to, get clicks and views for their website, whatever. And they don't manage money, right? They can come out and say so because they got no skin in the game. I appreciate Michael's views. I pay very close attention to what he says because he's got skin in the game. He's managing other people's money. He's got the same risk
just like you.
Of being wrong and what that means to, I don't see, if it was my own money, I could come out and say outlandish things, right? Because what I say and what I do could be two very different things. But I've got 3,000 families that I manage money for, and they listen to this show, right? They listen to the things I write. So I can't be coming out saying crazy things that, I'm not doing in their portfolios because they're going to call me out on it. But more importantly, I can't put their capital at risk. So everything we do has to be, really well analyzed for what that risk means for clients. And that's why I appreciate Michael, because he's in the same position I am. We may have slightly different views on things, but I think ultimately we're in the same position.
Yeah, well, I agree, and that's why I love to interview capital allocators, because they can't just sling opinions. They've actually got to be held accountable for their results. One thing, Lance, that I would encourage you, if there's time, to get into in the discussion with Michael, is he cares, just like you do, about the plight of the average American household. And, he's very concerned about the trajectories that we talk about on this channel, and not just maybe the dangers of the inexperienced retail investor getting sucked in, at a late stage, market mania. But I think even more importantly, going forward, just the fact that, more and more wealth is concentrating to the very few at the top, and that, 80+% and growing of the rest of everybody else is kind of getting stuck with the tab without getting to enjoy the party at all. And, I just know from talking to him that is something that, he cares deeply about. I know you do too. And it might be nice to at some point say, okay, let's put the markets aside for a second. Let's just talk about the economic prospects of Americans.
Yeah, no, look, that's a key issue that, again, when we kind of look at all of these different things that go on. So I prepared this slide for tonight because I want you to kind of realize the length that this market has gone to over the next few years or last few years. And importantly, what this suggests for corrections. And so if we start thinking about, okay, we're going to have this correction. Let's just assume it starts today, right? We're going to have a correction that starts today. So a 10% correction would take the market back to 54.42, right? So you're hardly even going to notice a 10, you're going to feel it, obviously, if markets are down 10%, but you're not even back to the linear trend from 2009 yet, right? A 20% correction gets you back to 48.37, right? Now you're just back to where you were at the peak in 2022, just a couple of years ago. So again, significant correction. Now you're getting towards the long-term trend. 30% decline gets you to 42.33. That gets you back to the bottom of the market in October of 23 when we really just launched this latest run. So we give back basically a year's worth of gains. A 40% correction gets you back to the bottom in October of 2022, right? So just to correct 40, I'm not setting aside the importance of a 40% correction at all. But when you think about the dynamics of how far we've come since 2009, these corrections is like, oh my gosh, 50% decline is going to wipe out the wealth of somebody. Well, yeah, it will. If you just started investing a year or so ago, you're really going to be hurt by it. For the average, for somebody that's been in the market since 2009, it's going to be pretty substantial. But even a 50% correction only gets you back to 2019, right? So that's how far we've pushed this market through all of this monetary accommodation. And Adam, this just goes to show you where all that FOMO comes in now. Mm-hmm. That we've pushed this market so far since 2020 that you need a 50% correction just to get you back to basically the trend of where we, if I run a trend line along those bottoms, that's about where 40% correction gets you. So 40% is a correction, 50%, maybe we start talking about a bear market, right? That's the problem of where we are. But then, this just goes to show you that, this is the problem, right? This is the problem with the markets. We've gotten things so elevated that you're going to need a sizable correction just to get back to some type of normality, between now and then.
All right, so let me ask you the question that I know everyone instinctively would ask then, which is then, all right, Lance. Well, do I need to sell everything and get out of this? Jesus, it looks like this market's just incredibly overvalued, and your answer would be no, because.
Well, because again, it may happen. Sure, it could happen. A correction, could happen next year. It could be a year from now. Look, there's been people calling for a major market crash since 2010, right? And we've elevated this much. You can go back and look at plenty of calls. I was very bearish coming out of 2009 as well, and saying, hey, look, this market's got a lot of risk to it. It's QE that's bailing us out, but we just keep doing it, right? It's just the amazing thing is we just keep funding this bailouts, but people have been bearish for years saying, oh, market's going to crash, market's going to decline, market's going to do this. And it just keeps going up. And, the problem is that eventually we're going to crash, but it could be, 5 years from now, it could be a decade from now. Maybe at some point the Fed actually shows up one day and says, hey, we're cutting rates to zero. We're going to do $2 trillion in QE a month. And the market says, nah, I'm not buying it. But when's that going to be? And that's the big risk. That's why, when we come back to all of this, is like, this is why we have to manage the markets for what we have right now. Yeah. My 21-point indicator says that I need to be at the moment. It's a very bad. Michael's indicators are absolutely right. The indicators say you have to be long now. Look, we have to manage money. We've got to grow wealth for when we can grow wealth. If we sit on the sidelines waiting for the crash to happen, not only do we lose money during the advance, we then lose money during the decline because we won't buy the market decline. You won't buy the bottom because then you'll be convinced the market's going to decline forever, right? And you put your money to work. And again, we've talked about this before. We still have people today showing up that have been out of the markets for a decade. And they're like, well, I need to get back in. I'm getting close to retirement. Well, now you want to get in now. It's a really, really tough. It's a really tough thing. So again, if we can just, long-term views are great, but they don't have a lot of value in managing your money because we just don't know what's going to happen. We don't know what's going to happen between now and next month. The only thing, look, and this is why, last week I could tell you, it's like, hey, we're going to get into a 2-week period of sloppiness. Be aware of that, right? Seasonal tendencies, actions that happen in the markets, those type of things makes that a pretty easy prediction to get right. I can tell you that probably through the end of the year, the markets are going to rally. That's a pretty easy prediction to get right.
Yeah.
Outside of that, nobody knows. What's going to happen next year? Nobody knows. It's all a guess. But we're just got to navigate what we get. And I think next year's going to, personally, I think next year is going to be a very tough year to manage money.
Yeah. Okay. And just to let you know, I'm hearing that from many, many sides. Jan van Eck, who's been traditionally pretty bullish, is now saying, I'm not bearish, but I'm a lot less bullish than I was. Michael Howell, one of the biggest bulls because of global liquidity flows, has said that he thinks that next year is going to be a disappointing year for investors, not necessarily a down year, but just after, multiple years of 20+%. If you get five, it's going to feel pretty disappointing. So anyways, when a lot of people use different methodologies but get to the same conclusions, that's just when my ears perk up.
Yeah,
Okay, go
think
ahead.
I think it's possible we get an 8 to 10% return next year with a whole lot of volatility. You know,
Very, yep.
yeah, and you have like a really great first 3 months. You have a 20% correction in the summer. It's going to feel like crap, and then you get a rally into the end of the year, and you wind up making 8% for the year. I think you should be happy with that.
And that was pretty much Felix Zulof's outline for the year, except it ends with an even bigger. So it's up, down like 15-20%, then up to new highs, then really down by the end of the year. So very courageous of him to be that specific, but again, he would agree, a lot of ups and downs, and you kind of the consensus of people that I'm talking to are more than normal saying active management is really going to be the way to get through this going forward.
Yeah. And look, and again, nobody really knows what's going to happen next year. The one thing that I am a little more cautious about next year is that we've had a 24% return followed by a 30% return. That's a lot of gains in 2 years. That's just a lot. And there's a lot priced into this market valuation wise, fundamentally, price of sales, et cetera, that at some point, I think the estimates for earnings next year are just way too optimistic. If we just get earnings back to trend growth, that'll be around 220 a share. That's about a $30 clip off earnings. And that's going to make valuations, if valuations stay where if people don't change the price of the market, valuations will be well over 30, actually approaching 40 at that point. So, I think that's, if earnings start to weaken just towards trend where trend growth should be, right? That's going to pull back markets somewhat.
Okay, yeah. And of course, we're seeing more and more firms go out there and say, hey, look, manage your expectations for the next decade in the market, given where valuations have gone, right? So, yeah. All right. One thing I just want to note, and Lance, maybe if you can get ready to pull up the S&P chart, and let's just do a quick look at where things are. One thing I just want to note is, there's the old Hemingway quote, how'd you go broke slowly and then all at once, right? Which is, to your point about things that can change sentiment, is things that don't seem possible today, just don't seem in the realm of possible. These black swans, happen, and oftentimes something that we think just simply couldn't happen actually can and does happen, and we don't know when these black swans are going to arrive. But we talked a bit about this earlier in the year, right? When after the debate between Trump and Biden, when right before that debate, the minute before Biden stepped on stage, nobody thought that Biden was going to be replaced as the Democratic nominee for president, right? All of a sudden, very quickly after that debate, a whole bunch of things that just did not seem possible suddenly were possible, and radical change happened very quickly, right? We just had a similar event go on in Syria, right? I mean, basically, the Syrian government fell apart pretty much overnight, right? Israel basically has taken advantage of that and carpet bombed pretty much all the military installations. So like Syria has like basically no military infrastructure left, as best I can tell, out of this. And who knows what the repercussions are going to be from that? I'm not going to make a good or bad call on this. I'm just saying that I don't think the Syrian government disappearing after 40 plus years, was on too many people's bingo cards heading into this month, right? I just You probably saw the same announcement from Javier Milei down in Argentina. Um, they've actually, am I correct on this? They've actually ended the budget deficit. Is that correct?
You got me on that one.
All right. Maybe I'll pull that up as I'm talking with you just to make sure that I'm saying this correctly. But basically, he has stopped the bleeding in Argentina. I mean, a complete fiscal basket case of a government, and it's been very painful. But he, I believe, has just achieved an accomplishment down there that is, I think, 2 years ago, before Milei came into office, people would have thought would have been impossible. Now we'll see what the
Yeah,
your
yeah. This is according to the Economic Times. Argentina's Milei achieves unthinkable by getting rid of the fiscal deficit.
Okay, yeah. So the point I just want to make here is be cautious about the confidence in whatever your outlook assumptions are, the things that you just think absolutely have to happen or absolutely can't happen. Um, uh, Sometimes they have a way of actually happening, or the thing that you think is just absolutely inevitable, does not. And so this again is sort of a reason for diversification and for hedging and for stuff like that as well. But you know, maybe this is just a gut feel, but I kind of feel like uh, there's going to be a lot more surprises in 2025, many of which we can't even imagine right now. Things that we just think couldn't happen or obviously would have to happen may not, and therefore, um, don't put all of your chips on, a single bet or two for next year. Like, or at least if you make a big bet, keep some in reserve for, okay, if my primary thesis turns out not to be right, how do I make sure I'm not wiped out by that?
Exactly. No,
Yeah.
that's right. But that's always the case, right? I mean, we've talked about that before. Is taking one-sided bets on anything. I'm going to be all long this and not long something else is really dangerous because if you're wrong, you lose a lot of money, and that's or you don't make money, right? And that's our whole goal is to make small bets on a diversified basket of potential outcomes. And when you're managing a portfolio, again, it's like we have AI stocks, right? Because the AI trade is going on, but we also have a lot of stocks in our portfolio that are economically sensitive to different things that not only help lift the price of the overall portfolio, but also shield you against market rotations. And so it's diversification of assets is very important. But it's also has to be done in a controlled manner. One of the big mistakes we see from people all the time is they have like five, they have 15 different financial advisors all doing different things, and they think they're diversified. And actually, when you actually get down and look at their asset allocation, they're very concentrated in a few areas. So, diversification, having a bunch of accounts, all across the country is not diversification. It actually increases your risk and lowers your performance over the time. Get with an advisor that you really like, that you really trust, want to work with, consolidate all your assets, and then really focus on your asset allocation mix to make sure you're diversified against potential risk outcomes and weighted accordingly for those potential risk outcomes. Looking at a bell curve, I've talked about this before, but if you're taking a 4 standard deviation event and putting a big chunk of your assets on it, that's a bad outcome.
Right.
You're the 90% of your assets should be within the first 2 standard deviations of that bell curve, saying this is what's probably going to happen. I can take some tail risk bets to hedge against the improbable, and that's okay to do that, but they should be sized accordingly.
Yeah, got it. Hey, speaking about hedging, I think we talked about this last week, but you know, markets obviously have a lot of euphoria in them right now, and the price of downside protection is relatively cheap. If you want to buy some long dated puts on the S&P, they are pretty cheap given to where they've been historically. Is this a good time in your mind, and have you been as a capital manager, taking advantage of this?
Not yet. At this moment, where the way our portfolio is structured, we're pretty well positioned for the end of the year. But yeah, if you're really worried about next year, buying some put out of the money puts, kind of long dated. Say you do a leap into 2026 as an example. You can buy those pretty cheap. Now understand there's a real risk that they're going to expire worthless. So don't do that thinking you're going to make money with that trade. The reason that you buy a long dated put is expect to lose money. You should go, I'm going to put $2,000 into this long dated put, and I expect that to go to zero. Right?
And
That's
maybe you hope that it goes to zero because it means the rest of your portfolio has done great.
right. So yeah, but just in case, if something goes wrong, then that thing increases in value and offsets some of the risk in my portfolio. So again, this is where we talk about weighting the allocation. Just don't go buy them for the sake of buying them because somebody said they're cheap, so I'm going to buy them. No, they have to be weighted. So how much of those puts do I buy? Well, how much risk do I need to hedge in my portfolio? So once I calculate how much risk I need to hedge, then I know how many puts I need to buy because that's a leverage bet on an outcome. So if my bet turns out to be correct, will it offset the risk in my portfolio? There's a lot of math to doing this, but if you do it correctly, it's insurance against downside risk.
Yeah. Okay. Well, again, folks, something to, talk to your financial advisor about. All right. Well, look, if we can, let's pull up the S&P chart. Let's just give folks an update on, what the technicals are telling us right now.
So interestingly, so again, last week we talked about the fact we're going to get this kind of chop to the market, and again, kind of almost on cue. Monday, Tuesday, Wednesday, Thursday, Friday, we've just gone nowhere. We sold off Monday, Tuesday, had a little bit of a recovery rally on Wednesday, sold off Thursday, Friday. We've triggered a short-term MACD sell signal, so that's going to put some additional downward pressure on the market here near term. That's why I think the sloppiness could go into next week as well. Also, the relative strength index is very close to kind of breaking this little uptrend it's been in. So I think we could see a little bit more decline. The market's not grossly overbought, but still a little bit more overbought than it should be at this point. So again, I think a pullback to the 20-day moving average, which is kind of this first level of support for the market, that puts you right around 6,000 on the index. I think that's fairly decently possible next week. And then after that, we're going to start to rally for end of the year. And again, that's where if you kind of run this trend line out, that's where 61, 6,200 kind of comes in for that kind of year-end rally.
Okay, great. And this so far is sort of playing out exactly as you thought it might. So, folks will keep bringing this up week after week. But right now, no surprises here.
Right. No surprises. And again, look, the market could start rallying again next week. The thing that we don't know is when does this portfolio rebalancing end? When has it all been done? And there's no way to know that. What we do know is that historically, this 2 weeks of December tend to be a little bit weak. And then starting on the 18th of the month, your year-end rally tends to start. So that's just the averages. That means some years are better, some years are worse. But given kind of the offsetting magnitude of how big this rally has been this year, that I wouldn't be surprised to see another week of some sloppy trading. Doesn't mean it has to happen. This market could start rallying for year end next week. So just, if there's positions in your portfolio that, you're underweight on that you want to start, bringing up to weight, and they've had a little bit of a decline here, I wouldn't wait until Friday to start trying to buy them. I mean, I would opportunistically probably start adding some stuff next week if you need to add risk for a year-end rally.
Got it. And also too, I just echo what we've said over the past few weeks, which is everything Lance is saying that the institutional money managers are doing here, you should be doing yourself in your own portfolio, right? In terms of your rebalancing and your tax loss selling and all your year-end planning, and time is getting tight for that. And as we've told people, don't procrastinate to the last minute. You call Lance's firm on December 31st. They're going to be very hard pressed to do much for you because they're scrambling to get everything done for all their other clients. So pick up the phone now and call your financial advisor or reach out to one of the ones that Thoughtful Money endorses, and make sure you take these steps while you still have time.
Yeah.
All right,
RMDs are a huge thing you need to get done now. Those take time to calculate and get the wires out. Don't wait until the last week of the year.
Okay. And RMDs, just most people know that, but that's required minimum distribution. If you're in a retirement fund and you are of a certain age, you actually have to start taking distributions from those funds.
Wow, sounds like you've been taking your continuing credits there, Adam.
Yes. Fortunately, it sounds like I've finished taking them. I'm glad to have that behind me.
That's awesome.
Yeah, I'm very jealous you live in a state that doesn't require them. But yeah, I had to do my 12 hours.
Well, anytime you want
Um,
to Texas, I'll help you find a spot.
all right, thank you. I'm more than half inclined, but my wife might take a little bit more selling, but maybe you can help with that, Lance.
All right.
All right, so real quick, just a few headlines I want to talk about before we get to your trades and then start to wrap up. Um, you probably saw this comment. I just want to get your feedback on it because I'm sure you've got some opinions. Um, just like when every politician is retiring, right? They give this sort of farewell speech where they talk about all the reforms that Washington needs to do. And you're like, wait a minute, buddy, like, where were you advocating for all this stuff when you were there, right? All of a sudden, now that you've got a foot out the door, you're telling us about how bad everything is, right? So Janet Yellen is realizing that she's not going to be Treasury Secretary for too much longer. And she basically did a mea culpa. She said, look, I worry a lot about how unsustainable, our fiscal trajectory is, and I'm sorry we didn't get that more under control. And there've been some articles written showing that, basically with her time at the Fed and her time at the Treasury, she's presided over the greatest accumulation of debt in U.S. history by far, relative to anybody else. And I did sort of a snarky tweet about this, and it's like, so what do we get from the central planners who basically rode this thing off a cliff while enriching themselves and their cronies in the process? We get oops, my bad,
Yeah.
right?
Well, I mean, and don't forget, Janet Yellen was every time Biden came to the podium and says, we want to spend money or this or spend money on that. She was like, oh yeah, we need to do this, right? We need to issue more debt. We need to do this. We need to fund this. The Inflation Reduction Act, that's a great thing. We need to do that. More clean energy. The Fed needs to, the Fed Treasury. We need to be involved in climate change. No, you don't. Not your job, right? But she was more than willing to step up and be the funder for all of these willy-nilly programs. And now, again, to your point, she leaves off. She's like, "Whoops, my bad." It's like, "Thanks, Grandma. We appreciate you. Thanks for the cookies and milk." Right? So, it's ridiculous. And I tell you, one of the most fascinating discussions you will ever have. And I've done this with a few people. I told you before. I did political talk all during the Obama administration. So I interviewed all of the politicians for the most part. Go sit down with them after they retire. I've had this conversation more than once, and they will tell you all of the crap that goes on in Washington that they'll never say while they're in politics.
Right.
Once they're out, yeah, they're like, oh yeah, it's this cesspool of just, government irresponsibility, and it's all driven by lobbyists and everything else. It's just, it's this ivory castle they live in. It's 5-star dining and private airfare and all this other stuff. They live the good life as long as they just kind of keep supporting the lobby efforts. But then they come out and it's like, oh yeah, well, government sucks. We need to fix these things. Well, again, why didn't you do that when you were in office? Well, because they can't.
Yeah. Well, and I'm really interested to see what happens with DOGE. I'm open-minded to the fact that it could be super transformative or it could be absolutely ineffectual. So we'll see what happens.
I think that is going to be the most fascinating thing we find out over the next 2 years, because this is you're sending in this very small group of mercenaries into a battle against thousands of people, right? I mean, there is nothing that they want to do that is beneficial. If you're a congressman or a senator or an aide or anybody in Washington, there is no benefit to anything that DOGE is going to do. They're going to be fighting them tooth and nail the whole way. So
yeah, it's going to be interesting. It's going to be kind of one of these like unstoppable forces versus the immovable object, problems, and we're going to see which one wins out here. Is it just the amorphous blob of the government bureaucracy that lives to protect itself and has 250 years of looking out for its own interest, right? Or is it going to be this group of disruptive mercenaries? I don't know.
yeah, and I'll tell you what though, if DOGE fails, right, which is a possibility, they completely fail, I think that is going to change the dynamics of the way people think about government and maybe the way they vote. I think one of the best things that may come out of this is that all of a sudden people go, you know what, I now understand how Washington works and we're going to start voting differently. Maybe I'm completely naive about this. I'm probably pretty wrong. But if this thing completely fails, I think that may be the point to where people wake up and go, I get it.
Like our government doesn't exist for us. It exists for it, right? Yeah. All right. Well, anyways, it'll be interesting because I can see Doge, if let's say it's successful, right,
Mhm.
and it gets rid of a lot of wasteful spending, right? And so government spending goes down. There's all sorts of knock-on effects of that that's going to be interesting, right? We talked about as go deficits, so go, market prices and stuff. Um, would a Doge success actually be net negative for stock prices, right? Because there's just less, liquidity out there pushing stuff around.
Yeah.
Um, I could also see Doge being successful even if the deficit stays flat, where you're just taking stuff that was being truly wasted and putting it more towards stuff that's useful, right? I wouldn't call that a clear victory, but it's certainly better than today, right?
Right.
Um,
If we can stop funding things like how frisbees fly and how cats scratch and those type of things, I think that would be probably a good step in the right direction. But those are such small things. Those are, $2 million here. Some of these scientific grants that they do are the most stupid things you've ever thought of. But we, provide a couple of $1 million for these, these
right,
science
sure.
research
But,
grants.
but even to
But
your point, let's take healthcare, right? I mean, what if we just took a bunch of money that was being really poorly spent and we still spent the same amount of money, but it was now on preventative care and all these other things that would be useful, right? Probably a good step, right?
be a good step, but wouldn't change the deficit to your point, but it would be a good step. Look, anything we can do to make things better, that's great, right? I mean, that's what we all want. We just want to make things better than they are now.
Right. And part of me also wonders, like, will the deficit go down under a Trump administration? Because he thinks big and wants to spend big on big things. So anyways, it's going to be really interesting. But to your point, probably one of the most fascinating things that we'll watch. Okay. Last thing I want to put up here, we can talk more about this next week, but I just want to flag it. So this is a chart from Mike Shedlock. Continued unemployment claims plus those with expired benefits has now topped 3.5 million. And I just want to point out the trajectory here. We've talked about this a lot. As this chart shows, in history, once the unemployment rate bottoms and starts rising, it generally does so right as we're heading into a recession, and then the unemployment rate really spikes, right? So is that going to happen this time? Well, we'll wait and see. But we're seeing the same trajectory at this point that we've seen in previous cycles. And so I just want us to keep our eyes on this because so goes the employment market, so goes the economy.
Right. And again, that's another one of our big concerns next year is that the economy weakens a lot more than people expect.
Yeah. Yeah. And I will say, from my recent conversation with Anna Wong, Bloomberg economics chief economist, who's been one of the most spot on economic predictors this year, she expects the unemployment rate to keep rising from here. All right. So trades, Lance. What trades have you guys made over the past week, if any?
None. Actually, it's been very quiet. We've had quite a few conversations this week. Again, just we were kind of set up for this couple of weeks here. We've got some position trades that we're looking at. There's some holdings that we have that we've been waiting for them to correct a bit so we can add to them. So we're now kind of getting some of those opportunities come up. So, once we get through next week, see how this kind of action goes, we'll probably add a little bit to portfolios just kind of for the year-end trade, and then we wind up taking them right back off again once we get into January. But yeah, nothing this week right now.
Okay. All right. I've got a little bit of a rant for us to get to real quick before we do. Just an update for folks, and I'm going to be a little cryptic on this, so I apologize, but it's all for good reasons. Um, you know, Thoughtful Money is now officially just a little bit over a year old by just about every metric. It's had a fantastic first year of its existence, and that's all completely due to you, the viewers here, who have supported this channel and made all this possible, as well as the talent willing to come on it. So that's folks like you, Lance. So thank you. But I'm always continuing to try to see how can we evolve the offering here and give people more of what they want. Many of you watching may remember the survey that I asked you all to take about a month ago. I've listened very hard to the feedback that folks have given in terms of things they'd like to see more of or things they'd like to see this channel start doing. So there are two new types of content that I've got on the docket to start releasing in 2025. And generally, folks, I don't like to announce what I'm gonna do in the future. I'd rather just introduce it and show you so that it's done and you get to enjoy it right away. One of these bits of new content is locked and loaded, and it's ready to start up first week of January. So you will be seeing it very soon. And Lance, I hope to be able to announce specifically what that is on this channel. I can just tell you, folks watching, it's going to put a smile on a lot of your faces, and I'll leave it at that. Secondly, you've got another different type of content that I think will be very useful for folks. That's going to start up a little bit later in 2025, probably still in the first half, maybe even in the first quarter. And I just secured how that's going to be funded. So again, let me remain cryptic on that, but there's good stuff coming, folks, and very, very quickly we'll start giving you specifics on it. All right, Lance, for today's rant, been doing a lot of counseling with my daughters recently, and one of them, one who's out of college, had a company that she was really excited to hopefully work for, very competitive. Just found out she didn't get it, so she's kind of crestfallen from that. And in that stage of oh my God, this is what I needed, and gosh, now that door's not open, and what a little bit of that sort of catastrophizing of just like this was the one best thing for me, and without that, life has no meaning, right? And I'm really using this as a chance to remind her that, hey, sweetie, one of the best lessons to learn early on in life is that failure isn't fatal, and there's actually 1,000 different ways to get to a goal, right? And if a door closes somewhere else, there's a zillion other doors out there that you can go through. And if you have to get creative, find a way to get through a window if you have to, right? And so I told her a couple of different stories, and I'm going to share them here. And then Lance, I'm sure you've got sort of your own stories here. The key thing from failure is you want to learn from it. Okay, if I didn't succeed, what can I do next time to get better, right? And growing up, my parents got divorced when I was super young, so young I don't even remember them being married. And so my brother and I were largely raised by, a single mom who wanted the best for us, didn't have a lot of support on her own, didn't have a lot of quality parenting to lean on. But she, in her mind, okay, great education means my kids will be successful. So literally from the moment I can remember, she told us, you guys are going to Harvard, right? I don't care what you do, you're getting into Harvard. And there wasn't a lot of guidance, but there was a lot of pressure. And my brother, my older brother, 4 years older than me, he got into Harvard. So he mission accomplished, right? I worked my tail off, applied to Harvard, got waitlisted, didn't get in. And my mother was convinced I had thrown my life away. I ended up getting into Brown, another Ivy League school. Lance, not good enough. Total waste of my. Now, this is from a woman who, had a junior college education, so it wasn't like, she had an academic pedigree to be, terribly snobbish from. But the weight that I felt, the crushing disappointment that I felt by not getting into Harvard, as an 18-year-old, really just it had a massive impact on my life early on. But I picked myself up, I dusted myself off, I went on with life. Fast forward to my mid-20s when I wanted to apply to business school. I had spent a lot of time trying to figure out, the mistakes I made, about things I could have done better that would have increased my chance of getting into Harvard. So anyways, ended up applying to several places for business school, Harvard, Stanford, I think it was Dartmouth was the other one. Clean sweep, which was great. Very fortunate to be able to have made that happen, but a big part of it was a lot of hard work. And I got to tell you, Lance, one of the most cherished memories I have in my life was being able to call up Harvard and turn them down, right? And so I tell that story just to say, look, yeah, there are moments and times where you really want something and the rug gets pulled from you and your hopes get dashed and it feels like the world is ending, but it is not. And with learning and hard work, persistence, grit, etc., you can, you can still achieve those goals if that's where you want to be targeting. You might find along the way there's an even better place to go. Um, but again, failure isn't fatal. It's just a way to tell you haven't quite found the right formula yet. You keep at it, you will. So I'm sure you've got some stories of this. You're one of the most persistent, gritty guys I know.
Well, I think first of all, I would tell your daughter. So if I was talking to your daughter, I would tell her, say, look, you didn't fail. You showed up, you made the application, you gave it your best shot.
Right. You showed up and tried. Yeah, exactly. Yeah.
That is success. You did that. Just because you didn't get the outcome you wanted just means that God has a different plan for you. That wasn't the right job for you. That wasn't the job that he wanted you to have. And so now you have to be open to what he's trying to tell you so that be open to those opportunities that now will derive from this. Keep looking, keep focusing. And, that's the one thing that, I see the most in people that fail is they fail that first attempt, right? And they, instead of looking at that as a success and then moving forward, they go, oh, I failed, I quit. I see this a lot in people trying to start a small business, right? They go, I'm gonna start a small business. They hit that first hurdle, it's like, oh, it's all over, and they quit and they go back to whatever they're doing. No, failure is a learning process, and it's a success every time that you fail at something. Look at something as a success. Okay, great. I succeeded at failing at that really well. What did I learn from it? What do I need to do next time? But more importantly, that was apparently not what I'm supposed to be doing. And God's plan says that I'm supposed to be doing something else, and I need to figure out what that is and let him push me in that direction. It's interesting. My wife is she has been working for this company. She's been building out a division for their company for a while, and they came to her and they said, we don't want to do this anymore. This particular division, we don't want to do. And she was devastated, right? She'd put all her time and effort into this. And I said, look, that you were having a lot of struggles with this. There was a lot of issues with the company, and you were miserable. And I kept telling, and we'd been talking for a while. I was like, hey, you need to, go put yourself out there and go find something else. But she's very determined. She's very diligent about what she's doing. She says, no, I'm going to see this through to the end, right? And that's me, by the way. I typically have to ride a horse until it's dead before I'll move to the next horse. And she's that way. She's very diligent about that. And within 24 hours of that happening, she had a better job. And it had been waiting there the whole time, but she had just not picked up the phone and called this one person that she'd been saying, I'm going to call for months. If she would have called this person 6 months ago, she would be where she's supposed to be now. But she was working on this other issue, and now she's in a better job with better pay, a better work environment, and it was sitting there the whole time. But she was determined not to listen to the message that was being told to her. And God was trying to push her in this direction. And if she listened, she's where she's supposed to be now. And this is the thing that we have to always remember, is that there's a plan for us, but we have to be open to what we're being told. And sometimes, it's like, I'm going to do it my way, and that's okay. And if things don't work, one of the lessons I learned a long time ago is, if you're trying to do something and it's just a struggle every step of the way, I mean, every time you try to do something, you're not doing the right thing. If you're doing the right thing, it will come very easily and things will just happen. And sometimes it's scary to go in that direction. It seems daunting at times. But if you're doing the right thing, if you're moving in the right direction, it'll happen fairly. It doesn't mean it won't require a lot of work, but the work will pay benefits much sooner than going in the wrong direction.
Yeah, that's absolutely true. And I was chuckling when you were telling your wife's story, not at her expense, but just thinking how many years I spent banging my head against a brick wall that I just needed to pick my head up and say, oh, what if I actually moved it this way? Yeah.
No, trust me. I can tell you plenty of stories about my life where I was just like banging my head on that wall, constantly going, I don't understand why I can't get over this wall. Yeah. And if I step back, there's a door right there. All I do is just walk around. It's just that's the way it is sometimes.
There's that old Stoic saying, right? When the student is ready, the teacher appears. And the challenge is, or the opportunity is, how do we as students, how do we get ourselves to the ready state faster, right? So that we can
Exactly.
take advantage of the good teachers, the good opportunities.
Right.
Your story about your wife there, this is the second story I was going to tell. And this is about sort of the, the universe's plan for you is, a lot of times, where we where we end up might not be anywhere where we imagine at the start of the journey, right? And part of our learning process is to go on the journey and realize that, oh, I thought this was the trajectory I should go on, but now that I'm picking up experience and perspective, this other destination's a much better fit for me. And I'm from a family of doctors. I mean, literally, my dad was a doctor, my mother's a research chemist, my stepmother is a nurse. Both my brothers are doctors. My sister-in-law is a doctor. And then if my aunt is a NICU nurse. And then if you want to get on the psychiatric side of things, my wife's a therapist. My sister-in-law is a psychiatric. I mean, they're just everywhere in my family, right? And it was very clear to me that I was going to be a doctor. And I actually think biology comes really naturally to me. I think I have a good temperament for primary care. I always could have had a decent sense of the type of doctor I wanted to be, and was pre-med in college. And right at the end of my college experience, this was in the 1994 is when I was graduating. This is when the Clintons were revamping healthcare, and every doctor I knew came to me and said, "Don't go in. They're ruining the profession. You should totally not go in. At least do something else for a couple of years, and then if you decide you really still want to come in, then come in." So I listened to them, and that's when I had to figure out, oh my gosh, I'm just about to graduate college here. I thought I was going to go to med school. What else am I going to do? That's what put me on the path to go to Wall Street. And even though I hated the culture there and all that, that then led me to business school, which then led me to the internet, which then led me to eventually what I'm doing today. And it gave me this series of skills and knowledge that actually, made what I do now possible. But what was interesting is for much of that journey, I felt like there's like a movie, what's it called? Sliding Doors, Gwyneth Paltrow, where like a stranger gets off, they miss the subway they were supposed to get on, whatever, and that just puts them on a totally different trajectory. And I felt like, oh my gosh, I stepped off my life's path and I'm now living this life that I shouldn't be living. Like that's the path I was supposed to be on. I missed my opportunity in life. And now that I've, found my way to what I do now, and it's sort of the perfect complement to everything that I've been doing with my life and how I'm wired up until now, I totally feel like I dodged a bullet. And no disrespect to any people in the medical profession who are watching this. I still have a massive amount of respect for people in healthcare. But now that I have a much better understanding of the challenges of what it means to be a health practitioner, and the people within my family and the other people I know elsewhere in life who are doctors and nurses and PAs and all sorts of things, who are just challenged by all the really rough and disagreeable parts and not unfun parts about modern medicine, practicing it, I think, my God, I would have gone crazy in a lot of the stuff. So again, I when I started, I never could have imagined, right, as I was cramming for my biology exams, that I'm going to be this financial media guy, right? But as I've said, when I started Thoughtful Money, like I finally found where I'm supposed to be in the world, and it feels wonderful to kind of be fully actualized. And it's not what I was 100% sure I was going to be when I was starting out at this journey, right? So it's another thing I'm trying to tell my daughter, which is like, just be open-minded, right? Like, focus much more on the outcomes you want. What type of fulfillment do you want to get from your job? And don't make it's got to be this exact profession. It's got to be some sort of profession that gives me this type of fulfillment. You might find the tapestry is much broader and richer than you initially thought.
Yeah, no, absolutely. I mean, when I was in college, I wanted to go work for Coca-Cola. That was my whole dream in life, and I never even set foot in the building. So,
Yeah. And I'm guessing now there's zero remorse, right?
yeah, no, yeah, exactly. But I graduated college, and a phone call came that said, "Hey, come help us do this." I'm like, "Sure, I can do that." And then one thing kind of led to the other, and again, I never got where I was thought I wanted to go. I wound up doing all these other things, from building health and fitness facilities to building, registered investment advisors and broker dealers and all kinds of stuff that I knew nothing. I knew absolutely nothing about building a broker dealer. I learned all that in a month, and you know, and so, you took the test. I took 5 tests in a month, and just so I could build a broker dealer. But that's, what I needed to do at the time, and it just, kind of snowballed into all this other stuff that's occurred since then. So yeah, just you have to be open to the opportunities that's coming at you, right? And be willing to listen. And again, when one door closes, it's kind of an old hokey saying, another door opens or a window opens, whatever. But it's true. We just have to be open to those opportunities. And even if the opportunity doesn't, it's like, you know, doesn't sound like that's something I really want to do. You may want to explore it anyway. Sometimes, we kind of blow off stuff, not thinking too much about it, but actually there's more to opportunities that may be out there that you haven't really considered before that you go, once I get into it, it's actually kind of very interesting. I like this, and I'm good at it, right? And that's a big challenge for us, is really finding the thing that we're truly good at, right? And that's something that a lot of people don't ever achieve. They never find that thing that they go do something because they're told that's what they're supposed to do, but they have a real talent for doing something else, but they never find out what that is.
Yeah, and this is why I really like that Johnson O'Connor test that you've heard me talk about before, Lance, is without having life experience where you've stumbled across that thing that, oh, I'm just naturally really good at this. The test does a really good job of giving you areas to go explore because, hey, given how you're wired, you're likely to be really good at this stuff, right? Can be a real catalyst to your progress there. Yeah, and to your point too, like there are experiences sometimes that you should consider taking, not because it's going to be the be all end all thing for you, but it's going to be an important development stage to then get to where you want to go, right? It's like a course, like I was telling my other daughter, like one of the things that happened in my time on Wall Street is I just lived on Excel, right? I'm actually, even though I do all this financial stuff, I'm much more of a creative type than I am a numbers analytical type. And there were a lot of like all-nighters basically trying to figure out how Excel worked and how build these formulas and stuff like that. But now it's just such a ingrained, intuitive part of my makeup now that it's this very valuable skill set I have that I definitely didn't have naturally. And I hated my time there on Wall Street. But there are skills like that I have coming out of it that have definitely served me super well later on in life.
Yeah,
Um,
absolutely.
all right, well, look, folks, Lance and I, we go out of our way to kind of tell some of these, share some of these, life lessons here. Hopefully to deliver some inspiration to folks that are watching this, whether you're a younger person watching this and wrestling with, your own journey in life, or if you've got adult children, hopefully this gives you some counsel that you might be able to share with them. And if you're older, you're not dead. There's still lots of lots of life ahead of many of you, most of you, hopefully. And hopefully, we give a little bit of inspiration that your best days might even still lie ahead of you. So anyways, that's what we do. And the last point on this too, Lance, is I don't want to be selling sunshine here. Certainly a lot of times in my journey where, the uncertainty was rough, things didn't feel great. I didn't like the work I was doing at a particular given time. And I think a really important part of this process, I know you're nodding your head and I know you've slept in your car for a number of years. Like, I mean, this all doesn't, it's not roses and sunshine all through this. But one thing I think that is important to do here is mindset. And, my wife's a therapist. And one of the things that I hated about therapy when I first got exposed to it through her was this whole thing about changing your mindset. And I was like, what are you talking about? Like, I've got this problem. Don't tell me to look at it differently. It's a problem. Let's fix it, right? And in a lot of cases, there are problems that you'll never fix. You'll just have to learn how to manage them, right? And nobody likes disappointment. Nobody likes rejection. Nobody likes failure. But if you can go through this process, looking at it as a process, looking at it as a journey, you can look at the disappointments along the way as growth milestones, things to be overcome, things I tried that didn't work. Okay, I won't try that again, right? But if you can hold the optimism that this is all to get you to a better place, it gives you the fortitude and just, the life enjoyment to continue with it all. Because like not every step is going to be a wonderful, enjoyable step. And it'll reduce your odds of what you were saying earlier of just getting discouraged and quitting. right?
Right.
Oh, I tried this thing, it sucked. Well, then I suck and I'm done with this, right? Just look at it as like, look, I know there's going to be, a lot of stumbles along the way. My goal is just to take more steps forward than times I stumble. And as long as I continue to do that, I'm going to end up at a better place. And I think that mindset is really critical.
No, no, it absolutely is. And this is why, you know, I'm going to say something that's a little bit controversial, but just bear with me for a second because
You
it's
say
just,
something controversial, could never happen.
well, I mean, it's just, look, I am a religious person. I have a fairly deep faith about things. And I've always made sure to try to impart that onto my children. And I'm not saying that you have to believe in, God and religion and all those type of things. That's up to you. Um, but the one thing that you lose out by not having faith, right, is you have nothing to hold on to in those really, really dark times. And the one thing about, having a solid, faith, a solid foundation in faith is that when things are darkest and like you said, I spent a couple of years, 3 years living out of my truck. That's pretty dark times. But if you have no faith, if you have nothing to hold on to, those things get really difficult. And
Mhm.
it's like, I have nothing to get me out of this. And the one thing that faith, teaches you and provides you is the ability to hold on to something, to hold on to hope that says, look, I'm here for a reason. I have to learn something from this. And if I do what I'm supposed to do, I will move forward. And that's what faith provides you, is that ability to look forward. The Blaise Pascal, the mathematician, he's like, if he did the whole math equation, just that basically, if I have to, disavow God or believe in him, if not believing him, potentially gets me eternal damnation, I'll take the risk of believing in him, right?
Right, right.
And so this,
Pascal's wager. Just, yeah.
yeah, it's called Pascal's wager. I wrote an article on this on our website because it applies to the markets too. But the issue is, and I know, and a lot of people are like, wow, it's all hooey, whatever. The one thing that that I told my kids this a long time ago. It's like, look, you have to choose whether or not you believe in God. That's your choice, and I'm not going to enforce this on you. I said, whether or not you choose to have faith or choose not to have faith, it just makes it really, really difficult in life if you have no faith, because without faith you have no hope, and if you have no hope, it's really hard to see what the future holds for you, and it just makes things even more difficult.
All right. All right. Well, look, Lance, we'll wrap it up there. I'm looking at the time, but hopefully we gave folks a lot to chew on here. All right, folks. Well, look, if the thing that gives you the greatest hope about the future is watching Lance Roberts on this channel week after week after week, let him know by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Um, as we talked about, time's running out for year-end planning. Markets are very richly valued. Who knows what's going to happen next year? If you've got any kind of anxiety, discomfort around that, then highly recommend, for any and all of those reasons, working with a good professional financial advisor, especially one that takes into account all of the macro and market issues that Lance has talked about here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and his team there at RIA, then consider scheduling a portfolio review / consultation with them. These are totally free. To do that, just go to thoughtfulmoney.com, fill out the short form there. The advisors will be in touch with you very swiftly after you do. Also, while you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the website to sign up for our free newsletter. And if you are subscribed to the newsletter but haven't upgraded to the premium version of it yet, but are thinking of doing so, make sure you upgrade before the end of the year. So really do it right now before you forget, because that price is moving up on December 31st or January 1st. And I want to make sure that everybody who can gets grandfathered in at today's low price. And just a reminder, if you subscribed, a long time ago at the much lower prices that we offered, don't worry about this price increase. As long as you remain subscribed, you're going to be grandfathered in at that original very low price that you picked. All right, Lance, as usual, I'm going to give you the last word here.
Nope. Have a great week. Don't forget to go shopping because Christmas is right around the corner. So
All right. I am hopping on Amazon Prime as soon as we log off here.
Exactly.
All right. Good week, buddy. Thanks so much. Look forward to seeing you next week. Everybody else, thanks so much for watching.